Joining us now is Avery Shenfeld. He's chief economist at CIBC World Markets. Bloomberg has crunched the numbers, and he's among the most accurate forecasters for U.S. payroll data. So, Avery, congratulations on that, and thank you so much for joining us. Let me tell you what. Let me ask you, I should say, what's the biggest take from this report? Because it was disappointing on a number of different levels. But what do you think the most important number is to look at?
Well, I think the key is the trend in private sector employment. And if we wanted to be charitable, we'd smooth the last 3 months together. You're looking at an average of 130,000, 140,000 private sector jobs a month if you throw in the last 3 months. That's not terrible, but it's not good enough. You'd need those numbers back over 200,000 to really start to make a dent in the unemployment rate. So this month's fall in the unemployment rate, I think, was just luck. And certainly, you know, we're not there yet in terms of being able to see the private sector driving the economy when all that government stimulus dries up.
Well, you do have people leaving the labor market, right? Giving up and not looking for jobs, which is why we had the unemployment rate drop. Can that be seen in any way as a good sign?
Not at all.
No, right?
I mean, I think if there's only one, no, this was the only thing in this report I think that was a positive was that we saw a slight lengthening in the number of hours worked per week. So part of the problem here in terms of getting new hiring going is that employers had cut the working hours of their workers. And so as output expands, they may not need to hire that many people back. They may just need to put their existing employees to work a little bit longer each week. That's still going to generate some income growth, but obviously on a sustained basis, that's not going to help you on the unemployment rate.
You know, that's for sure, Avery. You know, lots of numbers in this report. We go through them throughout the day. Bottom line, though, is this where we should be in the economic cycle when you take into account all the stimulus that's put into the economy?
No, it isn't. And the clock is ticking because that stimulus is going to run dry by the end of the year. In 2011, the economy is going to be living on its own merits without the helping hand of big government spending. And if we don't do a lot better, we're going to see much slower economic growth in 2011. So this is certainly one more thing, along with all the things that are going on in Europe and elsewhere in the world, for Americans to be a little bit concerned about that. We're running through that stimulus, not really getting the job engine going so that the economy can live on its own.
Sounds to me like you think then potentially that the selling that we're seeing in the equity markets today, we're down a lot, more than 3% on the Dow at this hour, that maybe it's justified because the disappointment in the jobs report, maybe the recovery isn't as strong, the stimulus money is running out, and then who knows how the heck Europe is going to play out.
I think the market is on to something, which is that this recovery, particularly globally, may not be all that they might have thought it was a month or two ago. That said, we've now come down a long way. I think the story in Europe isn't going to be as damaging to the typical U.S. equity as the market may now be fearing. So we may make some of this back, actually, in the months ahead if we get okay data out of the U.S. and the big fears from Europe don't really wash up on our shores in North America. But I think overall the market's right that the strength of the recovery, particularly as we look into 2011, may not be all that we had wished for a couple months ago.
What about, you know, and Carol pointed this out earlier, it's one of the first things I thought of when I saw that the numbers were disappointing. The fact that the Fed keeps rates on hold, the fact that any kind of pullback, idea to pull back stimulus kind of goes on the back burner for now. The fact that really everyone focuses on continuing to try and strengthen this recovery, I mean, isn't that a good thing?
Well, that's the one good thing here is that the Fed keeps getting more and more ammunition for its position, which I think is pretty clear. No rate hikes this year. We'll start raising rates when we've got a decent run of employment, and we don't have that yet. Doesn't look like even by the end of the year we'll have had enough job creation for the Fed to be contemplating raising rates. So in terms of equities, a stock that pays a decent dividend is going to look pretty good relative to, particularly now, relative to government bond yields that even on a 10-year rate are getting down close to 3%.
Hey, we got 10 seconds left here for you. What's the likelihood that we're going to see some revisions in these numbers and they'll look better than they do today? Just quickly, if you could.
Well, I never guess on a revision, but I would suspect that we will do a little bit better over the next few months than this number suggested.
All right. Good to get some time with you as well on this Friday. Avery, thank you so much. Avery Shenfeld of CIBC World Markets.